My name is Michelle. I'm the Executive Director of the Financial Management Association International, and I want to welcome you into today's research seminar in finance, economics, and banking. FMA puts these on in collaboration with the Finance, Economics, Banking, and Research Network. We call them FEBRN. Which consists of a number of different universities, including Aalborg University, where our moderator today is housed. So with that, I'm going to go ahead and introduce today's moderator, Cesario Mateus, from Aalborg University Business School, and also one of the founders of this particular network and seminar series. So Cesario, I'm going to go ahead and hand it over to you so you can introduce today's speaker.
Thank you very much, Michelle, for this short introduction. It is very much my pleasure to introduce our speaker today, Professor Steve Kaplan. Professor Kaplan is Professor of Entrepreneurship and Finance at the University of Chicago Booth School of Business in the United States. He conducts research on private equity, venture capital, entrepreneurial finance, corporate governance, and corporate finance. He has published papers in a number of academic and business journals, including the Journal of Finance, the Journal of Financial Economics, and the Quarterly Journal of Economics. He is a research associate at the National Bureau of Economic Research and the co-creator of the Kaplan Score PME private equity benchmarking approach. In 2015, a Fortune magazine article referred to Professor Kaplan as probably the foremost private equity scholar in the galaxy. He teaches advanced MBA and executive courses in entrepreneurial finance, private equity, corporate finance, corporate governance, and wealth management. Business Week named him one of the top 12 business school teachers in the United States. He co-founded the Entrepreneurship program at Chicago Booth. Well, I could stay here many minutes, but it's better to stop for now because for sure and absolutely everyone wants to listen to Professor Kaplan. Thank you very much once again for accepting our invitation, and we are looking forward to your presentation.
Great. Well, thank you, Cesario, and thank you, Michelle, and thank you all for being here. So let me share my screen and we'll get going. So I'm going to talk about private equity and talk about how it's grown. Then I'll talk about what the research finds at the company level. Then I'll talk about what it does at the fund level. And then, we'll talk a little bit about why it's grown so much and will it continue? And that, goes to thoughts on the future. A plug for my book. I've got a book that is based on the course that I teach and that Paul Gompers teaches that we wrote. So if you're interested in learning more, there's the book. So here we go. How has private equity and private capital grown? This is global AUM, and you've got buyout, venture, direct lending, lots of things, but you can see it's grown by, what is that, 3.5 times from 2013 to 2023. So, private equity, private capital have grown a lot. This is just another view from 2010. 2010, it's even lower. And this is Preqin. It's forecasting this to keep growing to, almost 20 trillion by 2028. This just shows that it's global. North America, from a couple years ago, North America is kind of half, Europe big in buyout, Asia big in venture and growth, but this has been a global phenomenon. And this is just a look at the US, and this is going to be where I focus a little bit more. And this is private equity partnerships. And by private equity, I'm really focusing on buyout. So venture, I'm going to talk less about. But this is annual commitments to buyout funds in the United States. And you can see, way back here, it was like, 25 billion. And, in the last several years, it's been about 350 billion. And this is money committed each year to partnerships. It doesn't get spent over the next 5 years, but these are commitments. And you can see it's just, this is why there's a lot of attention. It's just, actually been straight up since the GFC. And this is a slightly different view. This is looking at it as a fraction of the stock market. And the reason to do that is that the stock market has grown. And even when you take out the stock market, you see that the trend is pretty much up. And, in a particular year, the commitments are about, 0.8% of the stock market. And that's like, since the money is invested over 5 years, that's like 4 or 5% of the stock market in the US is just in buyout funds. So it's actually a meaningful amount of money. And if you want to do a back of the envelope kind of calculation, 5 years, that's how you're going to invest. And there's about 4% of the stock market in funds. And the typical deal is 50% equity, 50% debt. So if you double that 4%, you're basically at 8% of the stock market. There's co-investment as well. So, if you wanted to do a back of the envelope calculation, it's probably the case that about 10% of the value of public companies in the US is in private equity. So it's a meaningful fraction of the economy, and that's just buyout. If you stick venture and growth equity and real estate funds, that number would go up, maybe it double. So private equity is probably in the US 15, 20% of the economy, and Europe, it's probably, buyout is particularly large, might be 10% as well. So it's a meaningful fraction of the economy. So now I want to talk about what do buyouts do at a company level. And if you read the popular press, this is what you see. There's a book, These Are the Plunderers. Another book, Plunder. I wonder if they got together. The Problem of 12 by John Coates. There's a book about guns. And so these are kind of not very positive articles about private equity. And, the question is, what's the truth about what buyouts do at the company level? And this is where there is not one large sample study that's reliable that finds a negative result. So, the best results are from Davis, Haltewanger, Lerner papers that look at a large fraction of all US buyouts. They find there's a significant increase in productivity in those firms, whether it's private to private or public to private. And they find private equity firms get out of low productivity plants and they build or buy high productivity plants. And then work I did in the 80s found operating margins went up. Other work finds operating margins went up. In France, same results. UK, same results. And the only place where it's a little mixed is public to privates, where they don't find a negative result in a couple papers. They don't find a positive result on margins, but again, the Davis paper does. So if you look across just a large swath of research, you find productivity goes up. And employment, which is also, there's this view that jobs are always, cut in private equity deals. Again, the Davis paper, you find that employment growth is lower in existing operations relative to firms in the same industry. So there's some decline in employment, although it's not huge. If you look at new operations as well, employment growth is insignificantly lower. So again, it's lower, but not a whole lot. And there's a big difference between private to private and public to private. Private to private deals, employment goes up relative to the industry. And the place where it drops is public to private deals. And they're comparing, in those deals, you're comparing companies to other companies that are operating. But those are really kind of acquisitions when you take a company private. And an acquisition might be a better comparison. I think if you compared private equity to acquisitions, you'd find acquisitions also result in job loss. So the employment story that the buyout firms go in and just cut jobs is just not in the data. Yeah, and of course there are examples where they do, but there are examples where they don't. There's no significant difference in average compensation per employee. So the bottom line on employment is it's mixed. It's not the big negative people say, but it's, there's some job loss, particularly in the public to private. What about non-financial results? There are a lot of papers that get positive results. So paper by Fracassi et al., private equity firms increase sales with new products, geographical expansion, not increasing prices. Bloom et al. Have that paper and some others that find private equity firms have better management practices. Paper finds workplace industries decline. Recent paper finds that private equity investments in airports bring market improvements in airport performance. So that's why your planes are less late than they otherwise would have been. And, there are a number of other positive results. So you see, there are a lot of papers on the non-financial side that actually find positive results. So why the negative? Well, there are a few that get negative results. And, one of them, in for-profit education finds actually that the private equity firms actually increase profits. So again, going to this productivity story, it's consistent, but they take advantage of student loans, and it wasn't necessarily good for the students. There's also a paper that gets a lot of attention, the Gupta et al., that finds that private equity-backed nursing homes have worse health outcomes and compliance. That gets cited all the time. But those deals lost money. There's a problem with that paper. They were mistakes, and the private equity firms would not do those deals again. And it's a very few, it's one or two private equity firms that drive that paper, which gets a ton of attention because it has a negative result. And there's another paper actually that finds there were fewer COVID deaths at private equity-backed nursing homes. So again, the non-financial results are not all positive, but they're kind of dwarfed by the papers that have positive results. And you do have to be wary about bias. There's a recent paper in the Journal of the American Medical Association that here's the headline: changes in hospital adverse events and patient outcomes associated with private equity acquisition. And the bottom line in this paper is they say that after a private equity acquisition, Medicare beneficiaries admitted to private equity hospitals experienced a 25% increase in hospital-acquired conditions. Sounds awful. But in-house mortality declined and post-stay mortality unchanged. So there's a negative result and kind of a positive result. What did the press report? This is what the press reported. Private equity ownership of hospital made care riskier for patients. Increases in falls and infections. Nothing about mortality. Now let's look in a little more detail at the actual data. This is the orange are private equity hospitals, the blue are the control hospitals. In year -3, the control hospitals are better. In year -1, relative to the acquisition, the PE hospitals somehow got a lot better and the controls were the same. So, and then let's go to year 2 and 3, they're the same again. So it's not that the private equity hospitals are worse than the control hospitals. They're actually the same. They're slightly better in year 1, which is about where they were in year -3. It's this year -1 that's weird. And notice year 0, they're the same again. Actually, basically the same. And year 0 is the year the deal got done, which means that for half of these deals, the change probably happened toward the end of the year. It can't be private equity. So this paper, I think, is spurious. It's certainly questionable, and it's certainly not the case that the hospitals are worse. It's this change from -1 to 0 that's the bizarre thing. In year 0, you basically haven't had chance to make any changes. So this is what gets reported, and the data are not clear. So just beware. The press does not like private equity, and you are going to tend to see bias. The evidence consistently indicates that private equity investors make company more efficient and productive, and the non-financial results, not uniformly positive, but largely positive. So where does that value come from? So, back, I don't know, 15 years ago, Per Stromberg and I came up with sort of a rubric where, there were 3 things we pointed to: financial engineering, governance engineering, and operational engineering. And financial engineering are better incentives. Governance engineering is better management and monitoring. And operational engineering is actually helping the companies operate better. So financial engineering is simply, the management team gets typically a lot more equity than they get in public companies, or if they're running divisions. There's debt, which gives you tax benefits. Debt runs about 50 to 60% of the company. It's not the 80 to 90% it was in the 80s. Governance engineering is the idea that private equity investors basically control the boards of the companies and work closely with management, monitoring the companies. And then operational engineering is the idea that most private equity firms now are organized around industries where they have real industry expertise. And they use that industry expertise to identify how they can improve the company. And then when they invest, they have an idea of how they're going to improve the company. And so this view that it's all financial engineering, it's all leverage, is, I think, a dated view. And I'll tell you, Paul Gompers and Vladimir Makarliamov and I did 2 surveys of private equity firms, 2014, well, 2012 and 2020. And we surveyed actually a lot of the large firms. We got a real sense of at least what the private equity firms say they do. So how do they figure out whether to invest in a company? The business is the most important, their competitive position. The management team is second, but third is their ability to add value. So this is something where when they think about investing, they're thinking pretty consciously about adding value. Then we ask them, what's the source of value on their investments? And again, if you read the press, it's leverage, it's reducing costs, maybe industry level multiple arbitrage is buying low. What do the private equity firms say they focus on? Growing the business. And that actually makes huge sense if you think about it. Is how do you make money in a private equity deal? You have to sell the company at some point, either to a strategic, to another private equity firm, or to the public markets. And if you saddle the company with leverage, cut costs, and sort of gut the company, nobody's going to buy it. The way you get people to buy a company and pay for it is grow the business, and that is what they are focused on, because it makes sense. And this is the earlier survey. It's very consistent. We said, where do they expect to get value? And number 1, increasing revenue. Again, so this is 2012, this is 2020, same answer. And improving incentives was actually number 2. So they care about that. High value exit, so they're going to sell high, purchase at an attractive price. So that's buying low, selling high is there. And reducing costs is kind of, it's there, but it's it's down the list relative to these other factors. How often do the general partners interact with the companies? And this is the summer of 2020, so this is the middle of COVID. So it's maybe a little unusual, but the answer is they were 75% of these, 80% was once a week or more with their portfolio companies. So when there was a crisis, they were really hands-on. And just so you know, again, this is a little tilted, this talk, to being positive, but it's doing this to sort of offset all this negative thing, or the negativity you see off in the popular press. And it's accurate. So here's just what I was a judge for the some operational engineering awards for a few years. And these are the deals that are very successful. So the median deal in both 2021 and 22 had an IRR of more than 50% and a multiple of invested capital of more than 4 times. But what did they mention in these very successful deals that the private equity firms did? At least a quarter mentioned new CEO, upgraded team, new strategy, tech upgrade, new sales approach, new product. All of these are about improving the company and growing. Then you get improved efficiency, that's cost cutting, and acquisitions, which are, that's can be growth or cost cutting. But what you see is that for these very successful deals, it's very consistent with growth being important, cost cutting being there, but not the big driver. And basically, let's look at some examples. The plunder books, and if you read the press, they usually focus on the same examples: Toys R Us, HCR Manor Care. There's a few others now that are getting attention in healthcare. They never mention the positive deals. Let me show you some positive deals. EQT bought a company called Aldebaran, which was a plasmid DNA supplier. And they then took that and launched an mRNA manufacturing service. And they invested in manufacturing. Guess who they manufactured for? Moderna. They were a big supplier to the vaccines for COVID. And that was pretty good for the world. They made a lot of money. You never read about that. Maravai Life Sciences and GTCR, similar story. Global provider of life science reagents, which went into the vaccines. Don't read about that, but private equity played actually an important role in producing the vaccines. Apollo bought an airline in 2018. You would have thought that the airline would have tanked in the pandemic, but Apollo brought in new management. They transformed what was a business airline into a tech-forward, low-cost carrier. They expanded into cargo. They invested a lot of money, and they actually grew significantly during the pandemic and went public. Columbus Meats, which is the company I've written a case on, Arbor bought the company and invested a lot in new plant and took the company, which was regional, took it national. Francisco Partners, a specialty pharma services, TaylorMade Golf. For those of you who are golfers, KPS bought it, was losing money. Now it's one of the top makers of golf equipment. So that's KKR. So KKR now, part of their strategy is to give equity ownership down in the company, not just to top management. They think it works, and they've had good performance as a result. So I just put all these examples out there to show you that what you read in the press almost always writes the negative story. And the fact is, what I told you in the large sample, on average, it's positive. Well, if on average it's positive, they can't all be negative. So I just showed you some of the positive stories. So that's the bottom line, large sample evidence is positive on performance. The non-financial metrics also tend to be positive. Private equity investors get paid if they grow the business. That's what they're focused on. Again, you wouldn't get this from reading the popular press. So now let's go from performance at the company level to performance at the fund level. And now the question is, how do the limited partners do? So the general partners are the private equity investors, the KKRs of this world, and the limited partners are pension funds, endowments, etc. And you can improve performance at the company level and doesn't necessarily get to the limited partners because there are fees, which are not trivial, and you have to buy the companies. And particularly if you're buying a public company, you're paying a premium. So let's look at performance, and I'm going to talk about work that I've done a lot with Tim Jenkinson and Bob Harris. And all the results you're going to see are net of fees. So this is net of fees. We use Burgess data, which we think are the best data for performance because they get their data directly from pension funds and endowments. And so they don't have any reporting bias. And as far as we can tell, they have minimal, if no, selection bias. So how is performance measured? The industry does two things. They do annualized IRR, net of fees, and then they use multiple of invested capital, which is basically how much cash you take out compared to how much cash you put in. And both of these are absolute measures. They don't control for what's happening in the overall stock market. And let me now go to, that's how it's measured. Who measures it? There are a number of people who measure it. Burgess, we think, is the most reliable of these because they get their data from LPs. Frequent and PitchBook get it from LPs, GPs. They have to do FOIA requests. Cambridge Associates is probably reliable as well, but they don't really make their data public. So Burgess, we think, is the best. Now, it turns out I used another data set, Adipar, which gets data from family offices. And the results are basically identical to Burgess. So this is another plug for saying the Burgess data we think are very accurate. And if you look at family office investments in private equity, which is a completely different part of the market, their results in funds are basically the same. So what have IRRs looked like? Each of these dots, the black is average, the red is median, and it's pooled average. So think of this as a value weighted, whereas the median, is kind of equal weighted. This is the average IRR for all funds raised in a year. So you see in 2007 funds, the average IRR was 8%. For 2010 funds, it's more like 17%. So that's the annualized IRR. That then translates into a multiple of invested capital, which is how much money you get back versus what you put in over the life of the fund. And that ranges from 1.5 to 2 times. So, and I guess pre-2000, you had a year where it was below 1.5, but it's basically 1.5 to 2 times your money. And these are the most recent, this is the most recent data that we have. So now the question is this performance good or bad? And, compared to what? So that's where Antoinette Shore and I wrote this paper, almost 20 years ago now, where we said very simply, let's compare the investments in PE to an investment in a public company. And here's a simple example of how it works. Let's say you invested $100 million and you got back $200 million 4 years later. That's a 19% IRR, and you make 2 times your money. Now, here's another investment. You put in 100 million, you got back 100 million. That's 1 times your money and 0% IRR. Which investment is better? Well, naively, you would say, gee, this one's better because I made 2 times my money. But the answer is it depends. And let's give an example. If you put in 100 million in 2011 and got it out in 2015, you made 200 million. But if you'd put it in the S&P 500, you would have gotten back 185 million. And that includes dividends on the S&P. So you made 1.08 times your money, or you're on a relative basis, you were 8% better off. However, in this transaction, the private equity firm gets a fee. It's a carried interest. It's 20% of the profits. Private equity firm gets 20 million. That's 20% of 100. So your net PME is 180. 180 over 185 is less than 1. You are worse off in this investment as an LP investing in private equity. Should have just kept it in the public markets. Now, if we made investment 2 in September 07 and we got it back in 2011, well, the S&P 500 went down by 18% over those 4 years. So your $100 million is actually 22% better than 82. And of course, there's no profit, so there's no carry. So your net and gross are the same. So what you see here is from an LP perspective, investment 2 is much better if your alternative to private equity is public equity. So think of it as your equity bucket, and your equity bucket, basically investment 2 is a better relative investment. And so the Kaplan Shore PME just does this over an entire portfolio for a fund. And it's basically an apples to apples comparison of public and private markets. So now question, and if I could do a poll, which I'm not going to do, I'd ask you, how have buyout funds of vintages 2009 to 2020 done versus the S&P 500? And this is post GFC. How have they done? Better, equal, or worse? Let's see. The answer is, look at the blacks, and this is 2009 to 2020. These actually, the blacks and the reds. Blacks are average, reds are median. The average private equity fund, buyout fund, has outperformed the S&P 500 post GFC, and actually pre-GFC. You can go back to 1992, every vintage year, 92 to 2020. That is 29 vintage years. They are all better than the S&P 500. And again, if you read the press, you would not get this. There's a huge amount of disinformation out there. Ludo Philippou is responsible for some of it, and I'll explain that in a second. But the bottom line on these results are private equity has outperformed the S&P 500, and kind of the average PME is between 1.15 and 1.2, which means over the life of the fund, you outperform the S&P by 15 to 20%, and the S&P post GFC has gone up. So that's very impressive. And this is if you annualize it. This is a direct alpha, and it runs from 2 to 3% a year to more than 5% a year, but it's sort of been around 5% a year post GFC, and also over the entire sample period. This is if you compare to the Russell 2000, which is a smaller cap index, which might be better, but the outperformance post GFC is even greater. So you might ask, so this is just comparing to the market. So I'm assuming a beta of 1, and that turns out might be an okay assumption. If you look at Korteweg and Nagel have a paper, Greg Brown has a paper, and both of these papers, which are pretty recent and use cash flow data, so it's not the marks, it's actual cash flows, find that the betas of the funds are about 1, which would make this actually an actual alpha. But, again, relative to the stock market with a beta of 1, outperformance. So, there's some concern that the valuations are overstated. And, it turns out that if you look at, this is the results 2019 Q4, and actually it was the same thing. Most of the PMEs were greater than 1, but not by a lot. Then in Q3 2022, they went way above the S&P. Now they've come down a little bit, but it's still much higher. And you have to realize all of these funds, the earlier funds, are largely realized. So these results are accurate. These firms, may not be fully realized yet. So the NAVs, the valuations could come down a little bit, but they'd have to come down a huge amount in order for the PMEs not to stay above 1. And I have a group of investors, I ask about their NAVs, whether they're overstated. And they tell me their own funds are not. They say other funds, 50-50, and venture funds are still overvalued. So maybe the NAVs, these values come down a little bit, but, not a ton. So how do I reconcile all this with, Phalapu 2020, who, wrote the paper in 2020, he's still saying it in 2024, and generated, headlines like this: private equity barons grow rich, even though net of fees, private equity matches public equity markets. And same thing here. So let's see what's wrong when you hear that private equity hasn't outperformed. And I showed you, again, private equity has outperformed the public markets post-GFC and over the whole time. Buyout funds. Why does anybody challenge that? Well, let's see what they do. So first, he compared apples to oranges. What do I mean by that? Well, he didn't just use buyout funds. He stuck in natural resources, real estate, real assets, infrastructure, and used the S&P 500 for that. These are not equities. These are different. If you just used buyout, venture, and growth in 2019 with the S&P 500, you got a PME of 1.05. If you did that today for his sample period, 06 to 2015, so he's looking at funds raised 06 to 2015, he was wrong in 2019, he's wrong today. That's problem 1. Well, I'm going to say problem 1 again, that he's got real assets, natural resources, infrastructure, real estate. The PME of that to the S&P 500 is less than 1. But S&P 500 is the wrong benchmark for real estate. And he actually wrote a paper where he said, use the right benchmark, and then he used the wrong one. Okay, that's 1. 2, he uses the S&P 500, maybe the Russell 2000 is better. If you use the Russell 2000, then you get a PME of 1.11, not 1.05. And buyout only 1.14, it's 1.2 today. And even if you include these assets that you shouldn't, and you use the Russell 2000, you would have gotten 1.03 in December 29, and you get 1.1 today. So 1 and 2 are really using the wrong benchmarks. Number 3 is time period. He uses a weird time period, 06 to 2015. 06 to 08 were kind of the worst vintages in private equity. And it's not a natural choice. Why pick 06? Kind of would think you'd want to use 2000, turn of the century, or 09, post-GFC. So let's see what happens if you do that. So I showed you it was 1.05 if you just do buyout funds, 1.1 as of 2023. Now, if you use 2000, that goes to 1.1 or 1.14. If you use 09, 1.11 or 1.22. So the bottom line is he picked the absolute worst sample period he could have and biased his result downward. And you could actually do this. You can include the assets you shouldn't. And you would have gotten, this is what he got. If he'd used 2000, he would have gotten higher. If he used 2009, he would have gotten higher. Again, these are higher now. So again, if you look at the right benchmark and the right time period, you find the outperformance that I showed you earlier. And again, if we just use buyout only, and we use today, the average PME for 2000 to 2019 vintages, 1.18, and the average for 2009 to 2019 is 1.2. And again, means 20% better than the S&P 500 over the life of the fund, which works out to 4 or 5% a year. So again, it's just incontrovertible. Private equity has outperformed public equity over looking backward. Now, looking forward, who knows? Looking forward, I'll talk about in a little bit. But looking backward, it's just incontrovertible. And every time you read this in the press, look at it very skeptically. And so, Philippou is confused and or misleading. Okay, is there persistence? This is another question people often ask. Are there good GPs? Do they repeat? And if you could pick the good GPs, this is PMEs of over 1.4. If you're in the top quartile, if you're in the bottom quartile, you're basically performing at the S&P. And we looked at, this is again with Tim and Bob and Rudy Stuckey. We looked at persistence, and if you could get just top quartile funds, you would make 30% IRRs and PMEs of 1.7. If you pick just bottom quartile funds, it's a disaster. So can you predict? So let's look at the time the company is fundraising and look at how their previous fund is performing. So this is basically saying your previous fund is a top quartile fund or a bottom quartile fund. How does the next fund perform? And what you can see is there is no pattern. So looking at the performance of a fund when it's fundraising at its previous fund is not predictive. And this surprises some people. It is predictive in venture, but it's not predictive in buyout. Now, what happens to the poor performers? The poor performers don't raise funds. So what you see is when people are fundraising, they tend to be in the top 2 quartiles. And if you're in the bottom quartile, you're not fundraising. Now, it turns out some funds then do better and can fundraise, but there's sort of, people always say they never see a bad fund when they're fundraising, and that turns out to be true, but it's not predictive. You could look at the second previous fund. So this would be, sort of a little more reliable. And again, it's not predictive. So bottom line, it's hard to predict. Now, at the end of the fund, there is some persistence. So if you look at where a fund ends up and then where it is in the next one, you get persistence. But the problem is you can't tell when they're fundraising. So this makes it hard for LPs, maybe an opportunity if you can figure that out. So let me summarize at the fund level. Buyout fund performance has been remarkably good. Performance doesn't appear to be explained by leverage or risk, and there's not a lot of usable persistence. And the caveat is this is buyout funds, doesn't include real estate, venture, or infrastructure. And again, I showed you that including those, you still get performance that's superior to public markets if you use today's data and look back a long way. Okay, why has private equity grown so much? Because of performance, right? The institutional investors are not stupid. They look at that performance and said, gee, that's great performance. They invested and they've actually done very well. Second, private equity does provide diversification over holding public equities, particularly since there are fewer public companies now and they're a little tech heavy. Third, there's regulation. So it's gotten, more and more onerous to be a public company. And executives, kind of like being private, it's less costly. And in addition, executives now get help from their private equity investors with the operational engineering I mentioned earlier, and they also get paid more. So those are, 4 reasons why private equity has grown so much. And I think the same thing for private debt. You've seen money go into private credit away from the banks and away from CLOs. And I think you can tell some of the same story. So what about the future? What's going to happen to returns? What will happen to assets? Who will win? So existing deals, I think you'll see some of the performance advantage will be given up, particularly for the vintages of 2020 and 21, because interest expenses have gone up because interest rates went up. The S&P 500 keeps going up. It's a tough benchmark. And so I think you'll see the PMEs for the more recent vintages will come down a little bit. My guess is they're still going to stay above 1 pre-2020. And then the 2020 and 21, we'll see whether they continue to be above the S&P 500, where they are right now at their valuations. And you can see that these are the 2020 vintages still have a PME that's pretty healthy, but they could come down. New deals, I think you're going to see buyers and sellers will adjust. And there are 2 outcomes. Interest rates, if they come down, if the Fed, in the US reduces interest rates, you will see prices will come up and there'll be, buyers and sellers, deals will happen. If interest rates don't come down, the sellers eventually are going to have to sell. They'll be at lower valuations. You'll get deals. So their deals were lower in 2023. They should come back in 2024 and 25 because of the reasons I mentioned that private equity has advantages. Now, on the performance side, private equity firms tell me they're still looking to do deals at 20% IRRs and 2.5 times their money. This is gross of fees. And so if they can do deals at those terms, the risk return still looks like it looked over this period. And so, would give you a cause for optimism. And there are tailwinds on private equity. Operational engineering is real. CEOs, other things equal, actually prefer to be private. Regulation for now is less onerous for private companies. You can make long-term investments, and private equity brings diversification. Private debt has tailwinds, and the regulators don't want the leveraged loans in banks. And that's part of the reason it's moved to private debt. Now, why be concerned? At some point, returns net of fees should not be better than the S&P. Buyout fundraising has been substantial. The multiples you have to pay for companies are still high. Interest rates are still high. And you have this, the press is relentlessly negative. And that means there's regulatory risk. Will the SEC or the FCA or whatever regulators do something because of this perception? Antitrust is hostile to strategics. It's, becoming hostile also to private equity. So there's, as usual, there are tailwinds and there are headwinds, and we'll see how that plays out. Who will win? It's pretty simple. You have to beat public markets. If you beat public markets, you do fine. That's net of fees. If you don't, you have a problem. And regulations are painful for all, but they benefit the bigger players. So the mega funds actually benefit from regulation. And so I'm going to summarize, and then we have some time for questions. At the company level, private equity outperforms, and they are focused on growing the business, not cutting. At the fund level, unequivocally, buyout performance has beaten public markets. Whether that continues or not, don't know, but looking backwards, it has been very positive. That's why the private equity market has grown markedly, that and the fact that public markets are less attractive than they used to be. And going forward, it's, risk return looks similar to the past, but regulatory risk is the big risk. And there you go. Let me stop there.
That's great. Thank you very much for the great presentation. We have now time for some of the questions that they have been through chat. Nevertheless, the questions that will not be possible to during the remaining minutes that we have, we'll pass all of them to Professor Kaplan. So the first one is related that some analysts advocate that now is the right time to invest in private equity because we are in turbulent times, and having private equity a long-term focus, high quality companies should be more likely to be valued at the fair prices. What is your view on this? Is that the correct time to
this is
embrace...
it's very dangerous to, I can look at the past, right? And I've done that. It's always dangerous to predict the future because I have a 50% chance of being right and a 50% chance of being wrong. But here's what I would say. The private equity investors are very smart, and they have consistently innovated to get these returns. Because I 20 years ago, I said, no, there's no way they can replicate these returns. And I was wrong. I said it again 10 years ago. I was wrong. So I don't say it anymore. So they're smart. They're very incentivized. They have these operational capabilities. They are looking to do deals at these 20% IRRs that they've always used. So that's the positive. And the real question is, there's now more of this money out there, and it competes. And so you have to buy the companies, and does the seller get the gain rather than the seller and the private equity firm rather than the LPs? And so time will tell. I would say that the risk return to me looks somewhat attractive if they can do these 20% IRRs, and that's what they're underwriting. Then things have to go really wrong to get a bad return. But again, it's competition is powerful. So that's the answer. So it's a qualified, it's like a maybe yes.
Thank you. During your presentation, you referred that interest rates are still high, but there is a growing sentiment in the private equity industry that by late this year, the US Federal Reserve may lower interest rates. And of course, that will, the ECB, the European Central Bank, should follow that as usually. So these lower interest rates, if they are anticipated by end of this year, will reduce the cost of acquisition and the financing, and allow PE sponsors to return to leveraging their deals more effectively. What is your take on this?
There are two things. Actually, there's another thing that I didn't mention. So first of all, they will, the interest rate does affect what they can pay in order to get the return they're looking for. So if interest rates come down, or if they're confident they'll be able to pay more. And so what you saw last year is the buyers were willing to pay here, the sellers wanted here, and so you didn't have transactions. I think what will happen is the sellers have to sell because the private equity firms have to give money back to their LPs. So this will come down a little bit. And if interest rates come down, then the buyers can pay more and you'll get deals. So I think that's the sense. And if they're confident that the rates will come down, they'll go here. The other thing that has happened is the spreads on the loans have come down a little bit from the direct lenders. And that's the same thing as an interest rate cut. So if the spreads were, someone told me the spreads were 6%, now they're 5%, that's a 100 basis point interest rate cut. So I think the more money going into private credit is going to lower the spreads a little bit there. So you're get a double advantage. If interest rates come down, that helps. And then if the spreads come down a little bit, that helps. So that's why I think I'm pretty confident you'll get more transactions and the world will come back a little bit to more normal times, not like 2023.
Okay, thank you. We have as well from Maya, one of our attendees, that ask in terms of sustainability practices. So if you can give us some insights on how PE engage in improving sustainability practices of target companies.
So here's where that's a very, I can talk for an hour about that, but that's a great question. So what I will tell you is private equity firms maximize value. Okay. And that's I'm a Milton Friedman kind of person, which is controversial to some people, that, what you should do is maximize the value of the firm. Now, what's changed is, how do you do that? So now sustainability or caring about employees more, or various things that were probably maybe less true 30, 40 years ago are true today. So sustainability, there are some things about that really increase value. There are some things that maybe don't. Same thing, with employees. And I think what the private equity firms are good at and are committed to is they're going to do the sustainability type things that are value increasing. And they also have pressure from their limited partners to do some of this. But I think where they have an advantage over the public companies is the public companies sort of get pushed into one size fits all and doing things that, create value, but also doing some things that don't. I think the private equity firms will be better than that. So they are clearly doing things, whether it's sustainability or for employees, where they think it increases value. And I gave you the example of KKR, where they're giving more equity to the rank and file employees because they think it increases value. And that's a good thing for society too, if it,
Absolutely. Absolutely. A more direct question regarding NAVs. So the question is if the use of NAVs is okay in PME, given that they are gross of fees when cash flows are reported net of fees. So
no, the NAVs in the reported to the LPs that I'm using there, those are net of fees. So they will take a carry, at the NAV, they'll take out what the carry would be allocated. And so no, those are net of fees.
Okay, thank you. I believe that during your presentation, you addressed regulatory changes. And recently in the US, there is, in terms of transparency, for instance, the SEC intention to regulate PE firms with the ambition to bring more transparency. How do you think that could affect or not the private equity market if building up more regulation in terms of the private equity firms?
So this is where I think there's the big question mark. So the SEC put in regulations for more transparency, which actually some of them were reasonable in that the LPs ought to get good information about what's going on. Now, I think what they overshot, there's more onerous than it needs to be and more costly as a result. Who does that benefit? Benefits the big firms, because it's a fixed costs, and the big firms have lots of lawyers, lots of compliance, and it's a fixed cost. You have more assets, it benefits you. So the SEC, when they regulate like that, is good for the mega funds, not so good for everybody else. And it's sort of weird because it is an institutional market. The institutions, you know, if they're not sophisticated, they have consultants who are. So it was sort of, I'm like, you know, the Republican SEC commissioners were very much against this, and I, you know, would largely agree with them. Now, going forward, you know, the question is whether there's more onerous regulation that is even more costly, and that's a risk to private equity. I think that it's maybe their biggest risk.
Thank you very much. 4 o'clock, just one last short question, if you allow me, because there are so many of them, but then we pass to you because we need to finish. What is your view on GP paying capital gains tax rate on carry?
So that's a really complicated one, and I would say, you know, theoretically it's ambiguous, right? You can argue it both ways. I think what you have to worry about if you tax it as ordinary income is what I would do as a GP to get around it. And what I would do if I were a GP is I'd say, okay, no more carry. I'm not taking any carry, but in every individual deal, I'm going to do this so that I'm going to create a very thin equity layer at the top. I'm going to have debt, preferred, and a very thin equity layer. And I'm going to buy 20% of the equity of that thin equity layer. And I'm not going to net across deals. So no carry across deals. I'm just buying 20%. And so what would happen is the private equity person would get 20% of the upside in every deal, no netting. And it has to be capital gains unless you change the law. So I think that's what I would do. And the good GPs will be able to do it. So that's why it's tricky, is what the unintended consequences are. And so there you go.
Absolutely. Well, it's time to finish, and thank you very much on behalf of these 14 universities and with FMA International to be with you today, and over 200 attendees that they were looking forward to your seminar today. Michelle, do you want to say some few words?
I just want to echo your thanks to Professor Kaplan. Quite the punchy seminar today. I enjoyed it.
I told you.
Yeah, it's punchy, and it really, I think, in addition to everything that you highlighted with P's, I think it also highlighted the importance of us really looking at research and looking at data that's used and methodologies. You know, just to plug FMA's journal, FM, we started requiring all of the authors of accepted articles to upload data and codes into our Dataverse. And this really kind of underlines why we do that, because we really want to make sure that we're taking a critical eye at some of this research, to make sure that, you know, the contributions are correct, and done the way that they should be. Anyway, I could go on and on, like Cesario said. I do want to again thank you again for this really interesting seminar. I have recorded all of the questions that have not been answered, and I will pass them on to Professor Kaplan. We received 4 questions about whether a recording would be offered. After Professor Kaplan approves the recording, it will be distributed. And lastly, I want to invite everybody into our future seminars. Those are listed on FMA's website. The next one will be with Professor Laura Starks on April 11th. So watch out for emails and social media posts on how to register for that one. With that, I will wish everybody a good day, and I will sign off.
Thank you very much.
Thank you.
A lot of fun.
Thank you very much. Thank you.